Good morning, everybody. Happy Friday. It's August 16th, 5:26 a.m. Central Time. Grain markets are mixed this morning. Brian Split is here, guys. Let's start off with this price fixing story.
Yeah, so Kamala Harris is planning to introduce a federal ban on corporate price gouging. The presidential nominee's proposal would be the first of its kind and apply to the food and grocery industries. The plan will be unveiled today at a rally in North Carolina. Harris is expected to focus on the meat industry, which saw record profits following the pandemic, while consumers faced record high meat prices. If elected president, Harris has said she will crack down on potential mergers between mega supermarkets and food producers. Harris is also expected to announce additional proposals today to reduce the cost of prescription drugs and housing.
Brian, I asked Google's AI feature this morning about price controls, and this is what it told me. Price controls are a key feature of socialist economies where the government controls the production, distribution, and prices of goods and services. The goal is to ensure that everyone has access to the same resources, such as healthcare and education. In a socialist economy, the government regulates prices, wages, labor, and foreign currencies rather than letting demand and supply determine them. For example, the government might use price ceilings to fix the price of a commodity at a lower rate than the free market. Is this something we need to worry about? Or is this an empty campaign promise to buy votes?
I don't know. I mean, if she gets in office and she actually implements it, I think it's something we need to worry about. That's stuff that we've seen in other countries and policies in the past, and it just doesn't work. I think we've got history of it.
Is this something the farmer needs to be worried about? Crop prices are already dirt cheap. It's not crop prices that are killing us necessarily.
No, and a lot of times when politicians say this stuff, they're trying to fix something that's already been fixed by the market, right? Like Tyson's beef unit has losses for the last 4 quarters in a row. Okay, so it doesn't seem like right now they're taking advantage of the market by making obscene profits in beef at this point. You think about like when all the politicians start talking about using corn for ethanol and why we shouldn't be doing that. Well, they talk about it when corn gets to $7, $8, and then the market fixes it, right? Because it has its dynamics and it takes some time to work into the system. But the politicians will talk about it and then the market fixes itself. So this is something I think for people that don't understand how price fixing works. It sounds great. It sounds real nice that everybody's going to have the same price for everything. But then that's when things stop becoming available, right? Because it's too cheap and the market can't work itself out. And then you run out of stuff. So I don't like this idea at all, but
that was one of the last line, which I did not read from Google AI said this. This price controls can cause marginal producers to lose money and stop producing, which can lead to a loss of that commodity being available to consumers. So what you said is very much true. Part of me thinks that this is just an empty campaign promise. Inflation is a hot button issue in politics, and I don't know that the large companies that largely control this country are going to allow this to happen. You got to remember what this all goes back to. And the biggest problem in this country that nobody talks about is that we printed trillions and trillions and trillions of dollars in the name of COVID, climate, inflation reduction, ironically, and now we have a problem. And they're trying to put the cat in the bag, and they simply cannot. The government and the people that control the currency, they're like crack addicts. They can't stop. They can't stop printing the money. They're going to cut rates next month, and it's going to make money easier again. That's the big problem, and I don't know that it can be fixed. All right, let's go to corn prices.
So corn futures may negate Monday's reversal pattern. The most heavily traded December 24 contract posted an upside reversal on Monday following a neutral to friendly report from the USDA. However, very little follow-through buying was found after Monday's session. Large farmer ownership of unpriced bushels, both old crop and new crop, may continue to cap rally attempts. CFTC reported loosely that fund buying was offset by commercial selling in its most recent report.
Has the reversal been negated, Brian, or can we find some footing today and still hold on to our hopes and dreams?
I mean, so like when we had that reversal in July on the July WASDE report, we actually came right back down the next couple days, revisited that low, and then we started to work ourselves up. The reversal technically isn't negated until we take that low out. We talked about
390 and a quarter.
Yeah, 390. You see sub 390, the reverse is completely negated. What we might see here is a revisit of that support. If it doesn't break, then we could float back up again. We talked on Wednesday in the premium video about 2014 and how we actually saw a reversal like this in the August WASDE report in 2014. We just went sideways basically the rest of the month, and then the next leg lower happened at the very beginning of September when we took out that August WASDE low.
To go to fundamentals, what are your thoughts on farmer ownership? Is that still our biggest problem here? Is lack of demand the big problem? Is it just a combination of everything?
I think producer ownership on old crop is still part of the problem. But then there's the other part of the issue, which is the scope of this crop that is on deck that's going to be harvested. And I think the amount of that is unpriced. I've talked to some of the producers in, like, say, Missouri and Arkansas, for example, that are already harvesting. And boy, oh boy, these yields are big. At least some of these early numbers I'm hearing.
I can't say that out loud. Don't say that. It'll make people upset.
So John Deere stock surged yesterday. The company's stock climbed 4%, its biggest one-day increase since December 2023. The rise was attributed to Deere's third quarter earnings surpassing lowered expectations. Estimates were reduced earlier this year before the company announced it would be laying off an unknown number of employees. Deere reported a net income of $1.7 billion for the quarter, down 42% from the same quarter last year. Sales during the quarter declined by 17% to $13.2 billion. Deere is projecting net income for fiscal 2024 at about $7 billion. The company's stock is down 8% year to date.
So the sales were down 17%, which makes sense, but they've cut costs, and therefore the stock price, I guess, has acted okay. Brian, accuse me of a chart crime, if you will, but does this chart make any sense to you? Should Deere stock owners, shareholders, be concerned that commodity prices are in bad shape and that the farm economy is in a full-blown recession?
I mean, it seems like there's definitely a little bit of a lag here in Deere versus the corn futures itself. Yesterday was a big day in the stock market in general. So I don't know how much to attribute the gains yesterday to just overall buying. I mean, the S&P was up, 80 or 90 points. The Dow was up 500-600. I mean, it was just a big day of buying in general. But yeah, I mean, if you're looking at this, you'd say, wow, maybe with Deere back up, if it gets up near 400, that's probably not a place to own it anymore. And especially if we see the other side at 340, then it seems like that could really break down. But with the price of corn futures down and to me probably heading lower, makes owning Deere questionable to me.
Yeah, anecdotally, I have heard, and I think that our viewers will probably confirm in the comments, equipment sales are down and are going to continue to be down. The flip side of that is that Deere is a big company. These big companies are masters at managing margins and making money and staying afloat. That doesn't mean the stock is immune from moving lower, though. I'd be a little bit concerned about it, I guess.
The National Oilseed Processors Association released July crush data on Thursday. The U.S. Soybean Crush increased last month when NOPA members processed 182.9 million bushels, the largest on record for the month. The crush increased 4.1% from June and was up 5.5% compared to July 2023. Analysts expected the July crush to come in at 182.4 million bushels. End of month soybean oil stocks in July declined to 1.5 billion pounds, the lowest level since December. Stocks were well below the trade estimate of 1.6 billion pounds. They were also down 7.5% from the end of June and down 1.8% compared to year-ago stocks.
So we're crushing a ton of beans. This is no surprise. This is kind of par for the course now. I've used this chart like 100 times over the last few months, and what I'm trying to tell you here is that, yeah, the crush is excellent. Nobody is disputing that domestic demand is absolutely fantastic. The problem is that it has not been enough to offset lousy exports and big crops. But we're gonna keep crushing a lot of beans, Brian.
Yeah, I mean, I would expect that headline of the largest crush for that month in history is going to continue to be a headline that we see moving forward, just from the expansion of the industry. And we do have fantastic crush margins right now, so that's going to be the other element to it. And this is something that we've been gearing up for the last, year and a half or so,
Yeah.
with the expansion of crush. So another major issue, though, for the big picture is still using used cooking oil, right? So I remember going back a year plus and thinking about, oh, we need all of these bean acres because we need soybean oil to meet these initiatives. But golly, we use a lot of cooking oil every day, and then we can reuse it to turn it into renewable diesel. And I think that is, as long as regulations allow for it, that is going to be the primary source of use and primary preference for those guys.
And there's so many irons in the fire right now when it comes to policy and things that could change. It's really tough to keep up with, as a matter of fact. You got new stuff coming out of Washington, coming out of California, all sorts of places. That's probably a decent segue for this next story.
The USDA is advocating for easing the 45Z tax credit requirements. The current guidance requires farmers to implement numerous practices, such as planting cover crops and no-till farming. Farmers, however, claim that the guidelines are impractical. During an ethanol conference on Thursday, Secretary of Ag Tom Vilsack said that the USDA is drafting a proposal that would allow farmers to choose from a variety of measures. Additionally, the proposal would ensure that the tax credits are extended to crops beyond corn and soybeans. During the conference, Vilsack issued a warning stating that attempts to deny U.S. biofuels produced with foreign feedstocks the 45Z tax credit could harm trade with other nations.
So Vilsack said that they're working on it. And I'm sorry, Tommy boy, but it's not enough. It's not enough. We needed 45Z guidance months ago, and we don't. They're working on it. Cool.
All of this guidance comes way later than we need it. When you think about all of the, the RIN talk and any of these policy things that we need to get from the EPA, the USDA, it just takes longer than we need to.
Washington's in gridlock. Who's running the country?
That's a great question.
I know, seriously.
U.S. corn export sales were disappointing last week. Net corn sales fell below pre-report expectations and hit a marketing year low at 5 million bushels. The print was down 75% compared to the previous week and down 66% from the prior 4-week average. Colombia was the largest corn buyer for the week. Net soybean sales were reported at 8 million bushels. The print was down 32% from the previous week and down 1% from the prior 4-week average. The Netherlands were the largest soybean buyer for the week. Net wheat sales were reported at 15 million bushels. The print was up 24% from the previous week, but down 6% from the prior 4-week average. Mexico was the largest wheat buyer for the week.
The soybean export program is the problem. Current marketing year, old crop, which is going to end in a couple weeks, this is in all likelihood going to go down as the worst export program since 2013. And the new crop book of sales isn't really any better. I'll jump around here. So we're just above trade war levels in terms of new crop sales, and new crop sales to China similarly just above trade war levels. And if you go to corn, we're not doing anything special there either. China hasn't bought a single cargo of U.S. corn for new crop deliveries. So this is the flip side of the crush thing, Brian, is that soybean exports, old crop, new crop, you name it, to China, doesn't matter. They're all bad.
I mean, when you have a week when the Netherlands is your top buyer for soybeans, Colombia for corn, not good, right? I mean, we want to see Japan up there for corn. We want to continue to see Mexico be the top buyer for corn. Without Mexico last year, we'd be in a completely different situation for exports. And I hope that relationship continues this year, where they continue to buy aggressively. Remember, it wasn't very long ago. I remember that Mexico was not going to buy GMO corn, right?
Yeah.
And so that turned out to be nonsense. But this is not a good week for exports. And this problem with soybean exports, I feel like the buying is going to come in at some point. It's just going to be at lower prices.
China's going to buy more. I think I either wrote this or said this somewhere recently, but I don't like the idea that we have to rely on China for this, but we do. And China would be the one buyer of corn and potentially, or soybeans and potentially corn, that could move the needle really quickly when it comes to the balance sheets, and they're just nowhere to be found.
USDA released weekly drought monitor data yesterday. The majority of the Corn Belt saw below normal temperatures last week, along with mostly dry conditions. Scattered rainfall caused drought conditions to improve in portions of Ohio and Kentucky. Conditions worsened in southeast and southwest Missouri, along with east central Illinois. Temperatures were also below average across the high plains. Scattered precipitation improved drought conditions in eastern Kansas. Conditions worsened down in Oklahoma. When we look at the percentage of U.S. areas experiencing drought, corn country 6%, soybeans 7%, winter wheat 43%, spring wheat 21%, and cattle country 19%.
There are definitely some problem areas. I mean, like parts of Ohio, definitely problematic. Further east than that, you've got some problems. And then to the west, Kansas, Oklahoma have some problems, but the heart of the Corn Belt just lacking any sort of drought.
Yeah, when you look at your main, your high top producing states, we just don't have enough drought to be really concerned from a big picture standpoint. And then when you just look at the portions of our yield that are the top things that create yield or take away from yield, for corn, you're looking at precip in July and temperatures in July, and both of those were very conducive to large crops.
You're to the point now. We do have some rain on the radar this morning in Illinois, Indiana. I hope it makes its way to those places in Ohio. Forecast is kind of dry outside of that, barring the east. But I mean, this time of year, Brian, the markets just don't move on weather day in and day out unless you get late season flooding, early frost. I mean, we're going to start to look at South America probably.
Right. Yeah. I mean, the South American weather market's going to be the next potentially exciting thing. It's a little too early to get excited about dryness for planting. Give it a month and a half, 2 months. And if we're still thinking about why it's dry in Brazil, then that might start to matter to the market. But the domestic weather market, that is your May, June, and then the last gasp is usually in July. Unless there's some kind of hot and dry event that happens in August to really get the bean market going, that's about it. And so early frost is something that is very difficult to try and trade and price into a market. Generally, those are short-lived rallies if you do get those. So I think the volatility of summer weather is over. And we've got a couple months of trading other stuff before we get into weather again.
Cattle were lower yesterday.
They sure were. Feeders were down 65 cents to $1.25 lower. Live cattle were down 40 cents to $1.37 lower. Box beef had a positive day. Choice ended the day at $316.94. That was up 206, and select ended the day at $302.03. That was up $1.53.
Cattle market thoughts, Brian?
There was a pretty high level of correlation between cattle and the equity market during that 3-day sell-off in the equities, and the cattle market followed, right? And now the equities have really started to run higher, and we're not seeing the follow through in the cattle to the same extent. So that's maybe concern number one. We really got to watch 180 on cattle. So as this August contract leaves the board later this month, with October and December becoming the next contracts we're going to be focused on once August leaves. Cash market's going to be extremely important. If the cash can't hold up there and all of a sudden we got futures below 180, then that's a concern on the chart.
Outside market's pretty quiet this morning, guys. Crude oil is off $1.70 at $75.29 in the October WTI. Have a great weekend, everybody. We'll talk to you on Monday.